All right, today we're going to break down a really interesting investor watch list for 2026. We're not just going to list some stocks. Nope, we're going to deconstruct the entire investment thesis behind 6 different companies. The goal? To see what kind of stories they're telling us about where tech, global growth, and market turnarounds might be headed. But hey, before we dive in, a super important heads up. Please, think of this as an educational case study. This is absolutely not financial advice. We're just here to explore the process, to see how you can weave together business fundamentals with those big picture macro trends to build a coherent investment story.
So here's our game plan. We'll start by looking at 2 massive US tech giants that are at some pretty fascinating crossroads. Then we're going to take a trip to India and explore how to bet on a country's economic boom. After that, a bold play in another emerging market. And finally, we'll tie it all together with the key takeaways that you can use in your own analysis.
Okay, let's get right into our first section, reevaluating US tech giants. This is really a tale of 2 companies, trying to pivot, looking past the short-term noise and focusing on the long-term vision.
First up, Amazon. Now, for a while now, it's kind of been the black sheep of the Magnificent Seven stock group. So, the big question you gotta ask is, why? Why has it been lagging behind its peers? Because understanding that why is the key to unlocking the entire bull case for its future.
And this slide just lays out the shift perfectly. See, in the past, from about 2018 to 2022, Amazon was pouring cash into its low-margin retail business. Warehouses, delivery, the whole shebang. The result was a pretty low return on invested capital. But now, the story is changing. The new investment cycle is all about their high-margin juggernauts, Amazon Web Services and their advertising business. The whole bet is that this pivot will dramatically improve their capital efficiency.
And that brings us to this really important metric, ROIC, or Return on Invested Capital. Simply put, it just measures how good a company is at turning $1 of investment into $1 of profit. Higher is always better. And for Amazon, pretty much the entire argument for the stock hinges on this number going up.
So this is where it gets really powerful. The whole idea is this double-engine thesis. Okay, step 1 is simple enough. Amazon's earnings per share, or EPS, are growing. But step 2, that's where the magic could happen. As those high-margin businesses start boosting the company's ROIC, the market might just decide it's worth more and give it a higher valuation. That's called PE expansion. And when you get rising earnings and a rising valuation, boom. That's a seriously powerful combo for stock growth. Now on to our second tech giant, Netflix. And we're seeing a similar theme here of long-term vision versus short-term fear. The stock took a massive 34% hit after rumors swirled about a potential acquisition of Warner Brothers. You can tell the market got pretty spooked.
This slide nails the reason why. The short-term pain is, well, it's obvious. Buying Warner Brothers means taking on a ton of debt and absorbing a business that many see as kind of sick and slow-moving. That would almost certainly crush that ROIC metric in the short term. But the long-term gain? It could be huge. It could create a near monopoly in streaming with a jaw-droppingly massive content library. That would give Netflix the power to scale its profits over a much, much larger base of subscribers.
Okay, let's switch gears and continents. We're moving on to section 2, tapping into India's growth. And the stories here are less about specific company turnarounds and more about riding these huge, powerful economic waves.
So first up in India is IDFC First Bank. And honestly, this chart tells you almost everything you need to know. Just look at the tiny market cap of IDFC First compared to the absolute giants like ICICI and HDFC. The thesis is beautifully simple. It's a smaller, well-managed bank in a gigantic and fast-growing banking sector. The runway for growth is just massive. And it's not just us noticing this. The smart money is noticing it too. Private equity giant Warburg Pincus recently plowed almost 5,000 crore rupees into the bank. I mean, when a firm like that makes a bet, it's a huge vote of confidence. These guys do their homework, and they're usually looking for returns of 5, maybe even 10 times their investment. That signals they see something really big down the road.
All right, next up is the Indian Energy Exchange, or IEX. Its story is a classic case of what happens when a market gets a major shock. For years, IEX was the undisputed king, commanding about 85% of the power exchange market. Then, bam, the government announced market decoupling, which basically shattered its monopoly. The stock tanked 40% and has just been stuck in a rut ever since.
And that leads us to the single most important question for anyone thinking about IEX right now. Yeah, the monopoly is gone. There are now 3 big players fighting for a piece of the pie. But is the Indian energy market, a market that's expected to grow at twice the rate of the country's GDP, is it big enough for all 3 of them to thrive? The bull case is a bet that the answer to that question is a huge resounding yes.
Okay, for our last Indian stock, PVR Cinemas. The whole investment thesis rests on this big macro idea called the K-shaped recovery. You've probably heard of it. It's when, after a recession, the wealthy get even wealthier, while everyone else kind of struggles or stagnates. PVR, with its focus on luxury cinema experiences, is perfectly positioned to capitalize on that rising upper arm of the K.
And this timeline shows you PBR's incredible comeback story. I mean, look at this. During the pandemic, its earnings per share fell off a cliff to -123. But as the world reopened and the demand for those premium experiences came roaring back, profits returned. Now its earnings per share is right on the cusp of flipping from negative to positive. That's a huge turning point the market is watching like a hawk.
For our very last company, we're going to zoom out and look at a broader emerging market bet. This one's all about finding absolutely explosive growth and, importantly, diversifying away from just the US market.
So meet Mercado Libre, or Meli, as it's often called. The best way to think about it is as a kind of super app for all of Latin America. It's not just one company. It's this integrated powerhouse with 3 main businesses: a dominant e-commerce platform that people call the Amazon of Latin America, a super fast-growing fintech and neobank, and a really high-margin advertising business built right on top of it all.
Now, this is the core tension of the entire investment. On one hand, you have some serious risk. We're talking major macroeconomic and political instability in key countries like Argentina. But the reward on the other side is just as massive. I mean, growth rates hitting as high as 77% year over year, that's incredible. And for a lot of investors, it's a great way to hedge a portfolio that might be a little too heavy on US stocks.
Okay, so we've looked at 6 really different companies, each with its own unique story. Let's get to our final section and try to connect some of these dots. What are the common threads here?
When you step back, you can see that each of these picks was really driven by one of a few key ideas. The Amazon and Netflix stories were about improving that ROIC and hoping for a PE expansion. The stocks in India were basically macro plays, bets on the entire country's growth story. And Mercado Libre was a classic play on explosive growth and diversification. These are the tools, the analytical themes, that investors use to build their case.
And that really brings us to our final thought, a question you should ask yourself anytime you're analyzing an investment. Are you buying this company based on where it's been, on its past performance, or are you investing in the story of where you believe it's going next?